Hey guys, so in this video we're going to look at the indices. If you're scalping the indices, which are the ones we can look at and why I think indices actually present a really good opportunity at the moment for scalpers. Hey, okay, so we had a look at Forex, I look at commodities, and the kind of confusion is, okay, or the summary we came up with is, look, if you want to pick a market to trade regularly, you must be careful about the spread, must be careful about the commission in relation to how much it moves. The spread can be huge. If it moves a massive, gigantic amount, it's almost irrelevant. If its spread is huge and it doesn't move that much, then yes, there are opportunities, but as a benchmark, it might not fit something you want to trade 10, 15 times a day. However, let's have a look at the indices and let's have a look at some of the spread costs at the moment if we're going to trade them via a CFD or a spread bet, and then look at how big they move. And let me see why I like trading these from a scalping perspective and why I think that potentially this could be a profitable vehicle for you. All right, so let's look at the DAX. So DAX at the moment, as I am typing this, is a spread of 1.8. But however, I know that I was not typing this, I'm filming it. However, I know that it's actually less than that during the market hours. It's almost around a pip or a tick if you're trading the DAX during market hours. Okay, it's closed at the moment, but we think, okay, fair enough. So if we now have a look at the total range of the DAX, let's have a look at the total range of the DAX. Average true range, guys, is near on 170 pips, and it's coming down actually recently. So you've now got, and I keep saying pips, don't I, but it's ticks when we're talking about an index. So 170 ticks move to 200 ticks move with a 1 point spread. Admittedly, you've got a little bit wider after hours, so accommodate that, but even so, that's pretty decent, right? That's pretty decent kind of opportunities. And like I said, there could be multiple moves up and down within the whole day, but that kind of gives you an idea. Well, actually, I can probably trade that from a spread betting perspective or a CFD perspective, and the spread isn't too much of a damage to my position. Let's have a look at something even better at the moment, the Dow. So the Dow at the moment has got a range of almost 400 points, average true range of almost 400 points, and actually it's come down a lot. And I recognize we're in a volatile period, and there are times when I've traded it when it's had like a 50-point range, which is a waste of time from a scalping perspective. Day trading, okay, but just from now, when I'm filming this, we're talking about a 400-point range. And if you go and trade that via a spread bet, or you go and trade it via a CFD, it's about a 1.5 point spread. So you are getting a massive amount of opportunity for a very small spread. And again, reiterating, it's not the be all and end all, but the volatility is decent. You're getting drives up that are significant enough for you to get a good chunk of the move. You're getting different market phases. You're getting a distinct open, which I like. Of course, you can probably trade it 24 hours at most brokers, but I like the fact that there's a cash open, as there is with the DAX, as there is with the Dow. So the market opens, and that's the beauty of the indices, guys. And you know, we can kind of talk about the others in a second. But the beauty of the indices, of scalping the indices, is that you have a opening bell where everyone rushes to get their orders in, and that's don't forget the index is made up of the cash constituents and then repackaged into an index, even though it trades 24 hours a day on the kind of futures price. The fact that the cash index kind of has volatility at the open means there's opportunity there that's slightly different to, say, Forex, which although is 24/5 as we know, and it does move a little bit more aggressively at the open and close, but only because there is an influence from the cash section. So if you can trade the cash directly, you can say, okay, well, I can trade the opening hours and there's volatility there. I can trade the closing hours, volatility there. The spread is reasonably tight, so I'm ticking that box. The range is reasonably big. The moves are relatively clean, and go to this. Now, is this always going to be like this? No. There are times when the indices have been absolutely awful, and it's been yen that's been very, very profitable from a scalping perspective, or it's been crude oil. But if we're comparing these and we're looking at them and we say, okay, well, this is not too bad. Now, S&P 500 is a little bit different. S&P 500 has a far less of a range, if you like. Well, it has got a far less range. in terms of ticks moves or dollars moves. So you've got a $40 range. So let's say it's 2,700, you've got a $40 range, so reasonable. But if you were trading that, then, and now this is way better than some of the currency pairs, but if you were trading the S&P 500, let's have a look at what the current spread is at the moment. So the current spread at the moment is 5 points if you're trading it via a CFD or a spread bet. Now, considering this thing moves a decent amount, that isn't that great. It's okay, and that's always been the trouble, I think, with the S&P 500. If you're trading it directly on the exchange now, I might get some grief for this because the majority of people scalping in the US are trading S&P 500 futures. I get it. And it makes sense if you're trading on the order book because you've got a quarter point spread and you can sit on the order book, you can get filled, and then it starts moving your direction. You can kind of get a decent amount of bang for your buck if you like. But if you're trading it via a CFD or spread bet, it's why people have asked me over the years, especially people in America, so why are you trading the Dow? Well, because I can trade it from about a point, I can spread bet it, and I get a kind of same movement of the S&P 500, right? It moves reasonably the same pattern, but I get far more, my spread is far less, my costs are far less compared to S&P 500. And the one thing as well to point out between these two guys, and something which we haven't come across quite yet, is the thickness of the S&P 500 versus, say, the Dow, for example. And it could be versus the Nasdaq, but let's just use the Dow as an example. The order book is relatively thick on the S&P 500. And so you haven't got as much of a tick, many multiple tick moves as you have on the Dow. But the thing is that because it's so thick, if you're trading a market order strategy, you're paying more to get in because the spread's sort of potentially wider than if you just paid a pip to get in or a tick to get in or a point to get in with a spread bet. And so if you're constantly using market orders, it's not that useful to trade the S&P 500. If you're trading limit orders and prepared to sit on the order book, then it becomes better because you're capturing the spread, which is proportionally wider. So this is the kind of thing for you to think about in terms of your setup and strategy. I've always been, generally speaking, when I'm scalping, it's like, hey, I want to get on it now. I want to hit the market. And if you're doing that constantly on the S&P, you're going to get hurt, because even if you go and trade it via spread bet or via a CFD, you're paying, what is it, 5 points here. And if you're trading the market, you've got that quarter point plus the commission. So it's better to be able to work the order if you can. Now, I'm not saying it's not possible at all, but this is all about matching the market to your strategy. If you're the kind of guy or girl who likes to hit the market, likes to get into a trade immediately, you want that tight spread, you want that decent range. If you don't mind sitting there working an order, then the wider the spread, technically, the better, because if you're always going to get filled on the bid and filled on the offer, you're already capturing the spread. So it's something to look at, guys. Nikkei, that's a reasonable spread. It's 15-point spread if we're looking at CFD or spread bet. Range is kind of 300 points, so that's quite expensive. Better if you go direct. I've never traded the Nikkei. One of the things I've never traded directly on the exchange, traded it via a spread bet or CFD, but not an exchange, so not familiar with what the order book looks like. But that's one that comes in and out of favor, and that's really hammering as well. That can do 1,000 points in a day very, very easily. And Euro Stoxx, this is similar to S&P 500 in terms of thickness, i.e. it's much thicker than the DAX or the FTSE, so it doesn't move as much. It takes much more, thickness basically means how much volume and how much money it needs to move it to one more print up, one more print up, one more print up. The thicker it is, the more volume is required. You think about a few orders there, all it takes is a little bit of money and the thing moves 4 or 5 ticks, which is why the DAX is often swinging around like this, and the S&P might be like chug, 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 or Euro Stoxx might be chug, chug, chug. So it's something to bear in mind. Look at the cost of trade for you, particularly with your broker. Look at the range at the moment in time. Look at your strategy. We'll look at some strategies in a second, but look at the bigger picture and say, you know what, actually, maybe the indices are better. They're not all right for me. Maybe this one is, and then pick the one that works for you. The point is, there's so much choice out there. It's about picking what's right for you guys. Anyway, those are some indices. My favorites are definitely the DAX and the Dow, but some others there if they float your boat.